What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are taking a look at Target stock because the stock fell over 21% today, being that they missed on their earnings and they withdrew their guidance for the rest of the year. So they were supposed to do about $2.30 of EPS, and they only ended up reporting $1.85. And the reasons for this was because they said pretty much consumer spending was down, as well as the strikes at the port last month definitely hurt their profitability. So those were the two things, both of which I think are temporary, not long-term problems. And so that's why I was interested in buying this. Now, they adjusted their full year earnings to now $8.30 to $8.90 a share versus the previous $9 to $9.70, which is roughly an 8% drop. Okay. So really the stock should have dropped like 8%. 8%, maybe 10%, something like that. But no, it dropped 21%. So it's a little bit dramatic for how much it dropped. But now analysts are going to have to change their numbers here, right? But the main thing is, what is the valuation like now for this company? So if we're paying $121 a share, let's say 122, and we divide that by now they're going to do, we could even take the low end of estimates. Let's say they do only $8.30. We're paying 14 and a half times earnings. Okay. Well, right now, as you can see, the stock is at roughly 16 times earnings, trailing earnings. Okay. And for the last 4 years, pretty much the minimum it's traded at is a 14 and a half, right? So this could be the bottom for the stock. Now, if things were to get worse and maybe more people sell off the stock or more companies, maybe they issue price targets of only $100 or something like that, well, sure, then the stock can fall another 10% or 15% or whatever. And maybe the valuation goes down to 12 times or 10 times earnings. That's possible in a worst case scenario, or if we have a huge market crash correction, that could do it too. But we don't know if that's going to happen. It's kind of like a 50-50 thing right now. So this could be the bottom for the stock. That's why I was comfortable buying 15 shares. But if it's not the bottom and this stock goes to $100 a share, well, then I'm going to buy more shares. And then that $100 roughly should be the bottom. I don't know. It had to be really bad for everything would have to go wrong for this stock to be under $100. But it's Target. This is a pretty mainstream company. It's a value company. And I feel comfortable buying this. It's not like it's a dangerous company. If we want to look at their previous charts for revenue and net income, we can see that in the last 12 months, they did 107 billion in revenue and they did 4.3 billion in net income. Free cash flow is 6.5 billion. And keep in mind here, look at the last year, pretty much the last 2 years. Look at how much improvement they made in net income, but especially in free cash flow. Free cash flow was negative for these 2 quarters, and it's come all the way up now to $6.5 billion for the last quarter. So the numbers are definitely improving here. The dividends are going up. The cash to debt ratio is not very good. We're looking at 3.5 billion in cash and over $17 billion of debt. That's not good. The ratios, return on capital is only 3% now, and the margin is probably something similar. We're looking at what? Yeah, 3%. So it's not a great margin business, but it's Target. It's a pretty reliable company. A lot of people like going to Target, and we shouldn't have any problems in terms of that. But that's my analysis for Target. I think this is a good spot to start making a position. Maybe not, I'm not going to call this the end-all be-all bottom of the stock, but it's possible. And so this is probably a good entry point. And then if it drops another 10% or even 20%, you make sure you leave some more cash on the sidelines to pick up more shares when that happens. But that is pretty much all for Target. Thank you very much for watching, and I will see you guys in the next video.